Look at your portfolio right now. If you're like 95% of retail investors, you've been told that diversification is your shield. You've got some index funds, maybe some Apple, a bit of crypto, and you think you're safe. But here is the cold, hard data. In 2026, diversification is often just a fancy word for beta. You're not investing, you're just hitching your wagon to a horse that's about to walk off a cliff. I've analyzed Anton Kreil's delivering alpha models against the current 2026 market volatility, and the results are sobering. Most of you are monkeys buying the dip, while the pros are structuring asymmetric payoffs that print money when the market bleeds. Anton calls it delivering alpha, but after stress testing this with real capital at EDUxify, I call it the only way to survive the next 18 months. Today, we're tearing down the long-only myth and showing you how a retail trader named Neil went from clueless to a 3.4 Sharpe ratio in 3 months. This isn't hype. This is math.
Wait a second. A 3.4 Sharpe ratio? That sounds like moonshot nonsense. Most hedge funds struggle to hit a 1.0. Is this just another trading platform ad?
Valid concern. And that's why we're breaking this into 5 strategic chapters. First, we define the alpha gap, the difference between skill and just being lucky in a bull market. Second, we look at portfolio architecture, why having 9 positions can be safer than having 50 if you understand correlation. Third, we dive into the tactical execution of options, specifically how to use puts on piece-of-shit companies to hedge your life. Fourth, we hit the BS detector to see where Kreil's 2018 advice might fail in a 2026 high-interest rate environment. And finally, the mastermind verdict on capital preservation.
I'm just trying to get my Gold IRA sorted and maybe look at mortgage rates for a REIT. Does this apply to someone with small capital?
It applies more to you than anyone. If you have small capital, you can't afford a 50% drawdown. You need the asset trap protection we're revealing in Phase 4. If you don't know how to make money when the market goes down, you're not a trader, you're a victim. To understand why most people are losing money, we have to look at the math of alpha and beta. In professional terms, beta is the market return. If the S&P 500 goes up 15% and your portfolio goes up 15%, your alpha is 0. You didn't do anything. The tide just lifted your boat. Anton defines alpha as the excess return you generate above the market benchmark. If the market is up 15%, but you've structured a portfolio that returns 25%, you've generated a positive alpha of 10. Conversely, if you only made 5%, you have a negative alpha of 10. But here is where it gets spicy for 2026. For a professional long/short trader, alpha is actually a bit of a crude measure. Why? Because a pro doesn't care if the market goes up or down. They are looking for absolute return. In a year where the market drops 20%, a long-only retail investor is crying because their pension is hosed. But a trader with a professional mandate is making money on the way down by being short the junk and long the quality. The technical framework here relies on the long/short mandate. This means you have the freedom to buy assets you think will rise and sell, or short, assets you think will crater. This creates a market-neutral or hedged position where your wealth isn't tied to the whims of the Federal Reserve or global political factors. You are essentially betting on the spread between your winners and losers. Think of it like being a professional surfer. Beta is the wave. If the wave is huge, everyone moves forward. But if the wave disappears or crashes, the beta surfers drown. The alpha surfer is the one who has the skill to carve, turn, and stay upright, even when the ocean is a mess. Most of you are just floating on a pool noodle, hoping the ocean stays calm. Look at the Neil case study from the 2018 archives. Neil was a retail guy who knew nothing about markets 12 weeks prior. He didn't just buy stocks. He structured a portfolio with 9 distinct positions, heavily utilizing options to create asymmetric payoffs. This means his downside was capped, the price of the option, but his upside was massive. When you combine this with a high Sharpe ratio, which measures your return relative to the risk you took, you get a portfolio that doesn't just grow, it survives.
It sounds great on a whiteboard, but in my experience, the spread can kill you if both sides move against you. What's the Wall Street reality check here?
The reality check is that absolute return requires absolute discipline. Most retail traders fail because they buy the dip on a stock that's actually a piece of shit company. Anton's words, not mine, like Snapchat. They think they are being bra. Let's get into the portfolio meat. Neil's portfolio wasn't a random collection of moonshots. It was a masterclass in negative correlation. He had 9 positions. Some were macro plays, like being long the US dollar against the South African rand, USD/ZAR, a trade Anton calls one of the most exciting currency plays in years. Others were short-term punts using puts on Facebook to capitalize on volatility around congressional testimonies. Technically, Neil was using a long/short strategy with a focus on asymmetric risk. For example, he held a straddle on Macy's, long 2 calls and 1 put. This is a volatility play. If the stock kills it and rallies, he wins big on the calls. If the company craters to zero, he makes a fortune on the put. He only loses if the stock stays perfectly still, which in a volatile market is the least likely outcome. This structure smooths out the returns, meaning his equity curve looks like a steady 45-degree line rather than a heart attack.
But I've heard options are gambling. How does he get a Sharpe ratio of 3.4? That's better than most professional bank desks.
It's about the standard deviation of returns. Neil's annualized return was 57.9%, but his risk, volatility, was only 16.6%. The Sharpe ratio is calculated by taking that return and dividing it by the volatility. A ratio of 3.4 is outrageous. Anton himself admits he doesn't even trade at a 3.4. He did this by finding uncorrelated ideas. He was long a budget Brazilian airline, Azul, because they were eating market share regardless of the economy. Simultaneously, he was shorting junk debt companies like Spectra Energy, which were facing massive refinancing hurdles. If the global economy tanked, his Spectra shorts would print money. If it boomed, his Azul longs would fly. Think of your portfolio like a professional soccer team. You don't just put 11 strikers on the field. You'd get crushed. You need a goalkeeper, the puts, defenders, the macro currency hedges, and strikers, the high-growth equity calls. Neil's 3.4 Sharpe is the result of having a team that can play offense and defense at the same time.
I'm looking at the 2026 data, and interest rates are making junk debt even more dangerous than in 2018. If you're long anything right now, aren't you just asking for a margin call?
That's exactly why Neil's use of long-dated puts on Snapchat is so critical. He's not trying to time a one-day crash. He's betting that over the long term, a piece of shit company with no profit will eventually hit its true value, 0. He's buying time to be right. This is the asset trap we mentioned. Most people are trapped in the now, while the pros are trading the eventually. Now we leave portfolio architecture and enter the dirty work of professional investing, identifying what deserves to die. This chapter is not about hating companies. It is about spotting businesses where the math is already broken. Anton's framework is brutally clear here. Some assets are not misunderstood gems. They are structurally rotten. The professional does not short because a chart looks weak for 2 days. He shorts because the balance sheet, the refinancing schedule, the profit path, and the competitive reality are all telling the same story. That is the framework. The goal is to find companies propped up by cheap debt, hype, and hope, then structure positions so time works for you, not against you. Technically, the script gives us 2 lenses inside this fundamental decay short. The first is high-gearing junk debt, illustrated through Spectra Energy Partners. The second is pure fundamental rot, illustrated through Snapchat. In the first lens, the stock is vulnerable because leverage and refinancing pressure create a future equity problem. In the second lens, the stock is vulnerable because the business model itself may never justify the valuation. That distinction matters. One trade is a credit stress thesis. The other is a terminal value thesis. In both cases, the edge comes from understanding why the equity can get dumped when rates rise, liquidity tightens, or the market finally stops financing dilution.
So this is not just short the ugly chart. It is more like asking which company only survives if the market keeps forgiving it.
Exactly. Think of it like a dying mall. Most people see cracked pavement, fewer cars, empty units, and they say, maybe it comes back. The professional asks a different question. When does the mortgage reset? How much occupancy is left? What is the debt cost? And who injects new capital if foot traffic never returns? You are not betting against appearances. You are betting against arithmetic. Eventually, the mall does not just look sad. It closes. That is how you must look at piece of shit companies, not emotionally, clinically.
Now for the case study. The script points to long-dated Snapchat puts and is very specific. Neil used the $17 strike and the $10 strike. This is the essence of asymmetric construction. If the stock drifts lower to around $12, the $17 puts become in the money and begin producing steady directional gains. If the stock breaks through $10, the lower strike puts can accelerate in value through gamma expansion, turning a solid thesis into a major payout. Notice what is happening structurally. Neil is not trying to win a one-day prediction contest. He is buying enough time for fundamental gravity to assert itself. The long-dated structure is crucial because it lets him survive the noise, the meme squeezes, the fake rallies, and the social media bursts of hope that destroy badly timed short positions.
And that is where the danger begins. In 2026, the simple version of just short junk is not enough. Crowding kills. Short squeezes kill. AI-driven flows can rip apart a correct thesis if you are early, oversized, or sitting in the same obvious names as everyone else. My review of this chapter is that the real edge is not merely identifying rot. It is finding rot that is still under-owned on the short side. If everybody sees the corpse, the squeeze risk rises.
That is why the script's hidden sophistication is not the insult language. It is the structure. Long-dated optionality caps risk, keeps you from being margin called on noise, and monetizes conviction without forcing perfect timing.
Final portfolio lesson. Chapter 3 is about capital preservation through selective aggression. You do not short because you are bearish. You short because you have identified an asset where refinancing pressure, broken economics, or terminal value decay make downside more probable than upside. The hedge is not your opinion. The hedge is the instrument selection, the duration, the strike placement, and the position size. That is how a retail trader stops acting like prey and starts behaving like a risk manager.
Chapter 4 is where the amateur investor usually taps out because macro sounds intimidating. But the script makes a different argument. A real portfolio is incomplete without a core macro position. Why? Because if every idea in your book depends on one stock, one earnings call, or one CEO, then you do not have a portfolio. You have a collection of company-specific hopes. Macro is the layer that lifts you from trade picker to allocator. In Neil's case, that macro expression was long USD versus ZAR. This was not random Forex tourism. It was a view on capital flows, emerging market fragility, and the tendency for money to run toward the dollar when fear rises. Technically, this is the framework of global macro allocation. The point is not to predict every data print. The point is to hold exposure to a theme that is not tightly linked to a single equity earnings cycle. A pair like USD/ZAR can introduce negative correlation to an equity-heavy book because, in risk-off environments, capital often flees emerging market currencies and seeks dollar safety. That makes the position behave like a portfolio buffer. It is not magic. It is diversification with causal logic rather than diversification by ticker count.
So instead of owning 50 stocks and calling that safety, this is about owning a smaller number of ideas that react differently when the world changes.
Exactly. Think of a ship captain. Most retail investors only know how to sail when the wind is behind them. Bull market, they look brilliant. Liquidity wave, they feel invincible. But when the weather turns, they drift straight into the rocks because they never built propulsion. The macro mandate is the engine on the boat. It gives you self-determination. You are no longer begging the market to cooperate. You are navigating.
The case study is the U.S. DZAR trade itself. The script frames it as one of the most exciting currency trades because of structural weakness in the rand and the role of the U.S. dollar as a safe haven. More importantly, Neil used it as a core position over a longer horizon. That is a crucial distinction. He was not scalping noise. He was harvesting a macro trend. This is where portfolio thinking matures. The retail gambler wants a win today, but the portfolio manager wants a track record over 12 weeks, 1 year, and multiple cycles. The trade becomes part of a mandate, not a dopamine event.
And yet macro can humble anybody. In the 2026 environment, algorithmic flows, stop runs, and thin liquidity can blow through technically correct positions in the short term. My challenge to this chapter is that conviction without sizing discipline is just ego wearing a Bloomberg jacket. If you are going to run macro, your stops need more room, your size may need to be smaller, and your time frame has to match the thesis. Otherwise, you get shaken out of a structurally right trade by a 3-day spike.
That is why the script keeps returning to efficiency and self-determination. The objective is not to look like a genius in one trend. It is to become a trader who can press the button, hold risk across cycles, and understand why the position belongs in the book.
Macro, then, is not a side quest. It is the weather layer of the entire portfolio. It gives context to your equity longs, your defensive shorts, and your options hedges.
Final lesson. Chapter 4 turns trading into a life skill. A professional mandate means doing whatever it takes to remain profitable, whether the market goes up, down, or sideways. The hedge is not simply a put option or a short idea. Sometimes the hedge is a currency expression, a capital flow thesis, a safe haven bias, or a structurally negative correlated macro book. Self-determination means you stop outsourcing your survival to the next bull run. You build a portfolio that can breathe in any climate.
We need to have a very honest conversation about the title of this framework. Anton himself tells his students to scrub out the word alpha from the title of the presentation. Technically, alpha is a crude measure of a trader's ability because it is relative to a benchmark. In the professional world of long/short trading, alpha is largely irrelevant. The goal isn't to beat the market by 2%, it's to make money regardless of what the market does. In 2026, we are seeing choppy and very tricky conditions where traditional benchmarks are failing. If you are long only in your pension and buying 20% drops in your favorite names, you are the one going to get killed in the next 6 to 12 months. The technical reality is that you need a long/short mandate to survive.
Think of a 3.4 Sharpe ratio like a sprinter running a 100-meter dash in 9 seconds. It's breathtaking to watch, but you can't run a marathon at that pace. Most retail investors see these numbers and think they've found a magic pill. In reality, the alpha is just the skill of not being a monkey who buys every dip. The monkey sees a price drop and thinks, sale. The professional sees a price drop and asks, is the fundamental rot finally showing?
So the deception is not that the framework is fake. It's that the wrong people hear the word alpha and imagine effortless outperformance instead of disciplined survival. Smart.
Exactly. And the case study that exposes this best is the U.S. pensioner. Since 2010, many felt like superstars because their accounts grew from 50,000 to 130,000. But they were just hosed in the recent weeks because they were all crowded into the same tech giants. They are buying more as the stocks go down, and if there is a total collapse, their net worth will drop 50% to 70%. That is the BS detector. It tells you whether your portfolio is built on skill, structure, and hedging, or just on a decade of tailwinds that made everybody feel.
My proof of work in the 2026 tape says the danger is even sharper now. Making money when the market goes down sounds elite, but it requires massive emotional discipline. Anton's 2018 advice to just short the junk is harder in 2026 because high-frequency AI algorithms hunt for crowded shorts. If you aren't careful, you'll end up shorting the very things that go up 25% when the market goes down 50%. My verdict? You need modern tools and modern screening to ensure your shorts are not part of the consensus trap.
Final verdict. Chapter 5 is where the audience stops worshiping labels and starts respecting mandates. Alpha is not the mission. Absolute return is the mission. A strong quarter does not prove mastery. A resilient process over 6 to 9 months does. If your portfolio cannot answer the question, what makes money when the market breaks, then your capital is exposed. This is the risk evaluation every serious investor must pass before deploying size.
We've deconstructed the mechanics. You now know that alpha is a myth for the unskilled, and absolute return is the only mandate that matters in 2026. Your micro win for today: stop looking at your portfolio as a collection of things you hope go up. Rebalance your mindset to a long/short mandate. Ask yourself, if the market drops 30% tomorrow, which position in my account is going to print money? If the answer is none, you aren't a trader. You're a victim waiting to happen.
So the first win is not picking a ticker. It's changing the question I ask about every position I already own.
Exactly. But here is the asset trap. Knowing how to short is only half the battle. If you follow the consensus, you are just a different kind of monkey. You'll find yourself shorting a stock that everyone else is shorting, and the short squeeze will blow your account before the company ever hits zero. Avoiding the consensus short is the difference between a 3.4 Sharpe ratio and a total blowup.
That's the hedge question, isn't it? Not just, what's the short, but who else is already there? How crowded is it? And how violent can the squeeze get before the thesis pays?
Final consensus. Capital preservation is not passive, it is engineered. The investor who survives the next cycle is the one who combines long/short mandate, negative correlation, asymmetric structure, and crowd awareness into one repeatable process.
We cover exactly how to find those uncrowded short ideas in our next episode. Avoiding consensus short ideas. How to find shorts that actually drop when the market crashes. Don't be the retail trader who gets hosed by a 25% spike in their shorts while the world burns. Download my raw 30-day performance data and the 2026 Risk Hedge Worksheet at EDUxify.com. Subscribe and join the 1% who know how to profit from the collapse. We cover the consensus trap next. See you there. Knowledge without execution is useless. Thanks for listening. Your next step is waiting at EDUxify.com. Go grab the free cheat sheet for this episode. If this brought you value, follow the show and leave a rating. Don't miss the next episode, because we are uncovering a massive blind spot most people ignore. See you in the next one.